college grads coming out now have like a really challenging time.
Where do you guys think the winners are going to be and the losers over the next 5 to 10?
It's going to be the groups that are not only able to buy assets, but are also able to squeeze the juice from them.
I think if anyone is like stressed and constantly staring at your stock portfolio, you should probably like de-risk and go into cash flow recession resilient asset classes.
Our entire business model is based off of being resilient in a recession.
We're not sitting here saying that there is going to be a recession, but damn, there's a lot of things right now that could go one way and get us into a recessionary environment.
All right, welcome back to another cash flow quest. We're doing the panel again. We're having fun, I'd say analyzing the macro. There was a big day yesterday with Iran, and it was Tuesday, April 7th. And so it was like a big deadline for Trump. And so we are going to hit it, be more just kind of in the middle on the political side. We're not trying to dive too deep into it other than to analyze what it did with Treasuries and what it's going to do for the real estate market, who's going to kind of win and lose, how we kind of analyze deals and look at the risk and the rate volatility. And so, but the headline is kind of what we were kicking around, Ben, is the Treasury. Mm-hmm. And kind of, we were starting to get a little nervous that Treasuries are upticking more permanently, and it makes us a little nervous. And so we figured we'd share some of like our internal dynamics and how we view the differences in risk and how do you go into escrow and or tie up a deal and have a contract, and when do you kind of bring up the risk of Treasuries and pricing and all that stuff. So we're gonna have some fun, and we have some. Basically, there was a 0.5% swing. I don't know if you want to hammer the summary of what happened over the last month or so.
Yeah, I think just since the war in Iran broke out, why Treasury yields, you would think that when the war would break out, that Treasury yields would go down. We talk about this a lot. And you would think that gold would go up. And actually the opposite has happened in that Treasury yields increased, meaning people are selling Treasuries, and gold sold off. And there's some dynamics at play there. But like Econ 101, you'd be like, the war is going to break out. People are going to sell out of the stock market, transition into safe havens, into Treasuries, and it's going to drive down Treasury yields. But like that, like correlation has been broken. I think like the bond market in general has been broken. It's like you can't really predict it. But why Treasury yields were increasing, I mean, one of the reasons why I think they were increasing was because of this war had so much to do about oil prices as well with the Strait. 20% of all global oil comes through that Strait, that 22-mile, let's call it.
Strait of Hormuz.
Yeah, that,
commit.
that bottleneck there. And so the fear is that if energy prices were to continue to increase as oil got up to like 100 and, close to 120 at one point, that would cause inflation to creep, and it would prevent, just even globally, global central banks to increase rates because of the fear of inflation running away. And like Blake, you and I were kind of chatting about just like we're going into a contract on a huge deal, and like I'm sitting there like, oh my goodness, like kind of a risk. And I remember you saying, well, this is when the boys become men, and we can't worry about these things now. And then today is April 8th. I texted you, Trump didn't blow Iran off the face of the earth or whatever his tweet said. And the Treasury's sitting at 4.2. So it's one of those things where there's a lot of noise in the market. I know that there's a war going on, so I don't want to call it noise. I mean, it is real risk, but you can't like live in fear as you're managing risk and like going to buy deals and sell deals, and absorb all this information. You just have to like continue to like, as you said, like boys become men. You got to continue to like focus on the things that you can control and then mitigate and hedge risk as much as possible.
And get to see the table.
Yeah.
Like, until you're in escrow on something and you have a contract and a legal obligation to kind of come to the table and make a deal, technically all the terms will be relatively drafted and you're in a contract. But then if something goes wild, like I was under contract on deals in COVID, like literally when it broke. And it's like, you just learn, like you just make a couple phone calls and tell them like, hey, I got a new problem. This is a new challenge for us. And we're going to have to navigate this. We'll keep the communication lines open. But like Treasuries have been swinging the last few years, pretty wild. And so If it goes like beyond a certain level, let's call it like 0.5%, and then maybe upwards on the higher end, like a whole percentage point swing from the time you lock in a deal and you're kind of trying to lock rate or get your loan closed, like you just are going to have to raise your hand and be like, hey, I got a problem here. Our rate has gone up a whole percent. I'm going to have to ask for some credit because it's just breaking the math.
Mm-hmm.
And, most of the time it doesn't though. And that's the key. Like you don't want to worry about something. It's like, what are the facts today? And you got to keep going. And the persistent and consistent effort is key. But I have some color. I've just been doing some research with some of my gold bug guys. What was interesting in the comments, also Peter Linneman was like, this was a head scratcher. He's a School of Economics in Wharton, I think it is.
Mm-hmm.
And he mentioned like the Treasury went the wrong way, Well, the dynamic I learned from my gold bug guys is everyone was in right then a liquidity crisis. So they started to need cash, even just like the thought of Hormuz closing, the Strait of Hormuz closing, everyone was like, shit, we need more cash. And so they sold treasuries, they sold gold.
Got it.
And that was
the fun liquidity.
They needed liquidity because their income streams were going to shut off, and maybe even in the anticipation of those income streams shutting off. And so it's a short, like every takeaway I've received, and gold's now rebounding. It's like 4,800 an ounce, and so it'll probably trend back over 5,000 here soon. But that's what everyone's saying. I kind of tend to agree. The treasuries was the same thing, that you need cash, and like countries hold treasuries in big ways.
Yes.
And so they had to liquidate certain assets, and those are the quickest and easiest to liquidate. And so we saw weird blips in the pricing.
Yeah. Yeah. And it makes sense too. And especially like Asia or Europe or a lot of these countries that are more dependent on this oil from the Middle East. I mean, no one's immune. I mean, we're in California. And I was reading in the Wall Street Journal, and I was telling you about this as well, that California, we import a lot of oil from the Middle East. I think just geographically where we're located in the United States, that they're saying that California brings in and ships more imported oil. And so we're going to get hit the most by whatever's going on with the Strait. Yeah.
I didn't know anything about that.
Did not know that either, just until I read this Wall Street Journal article. And so like gas right now is like $6. It's pretty expensive. But why I say that is because like Japan, Korea, South Korea, that is, all the European countries, they're very dependent on Middle East oil. And so it would make sense, and they're large holders of U.S. treasuries. It would make sense to what the gold bugs are saying, is that they had to sell treasuries because they're like, we might need liquidity to then like help buy more oil at a higher price. If the supply gets cut, we need to have higher reserves in oil,
Yeah,
whatever it is.
Turkey sold 58 tons of gold.
Wow.
Because they had to buy oil. How wild is that?
It is pretty wild.
So like think about that supply burst into the market, and so you see these little kind of quick little, blips in the radar of the pricing, but it's crazy. And you think about those. So I was looking up. So let's see like how much, around 29% of California's crude oil imports were sourced from the Middle East.
What is it?
29. So call it 30-ish percent.
Oh, okay. Yeah.
I will say the rest of the country got down to $2, and we were at like $5.59 because we have so many taxes here in California.
Oh yeah.
So
being
like
an extra
$6
$1 on every gallon.
Yeah, depending on where you are in the country, we're up like $1, $1.50. We're not up $4 or $5 compared to some other places.
I bought diesel yesterday, $7.50.
Ouch.
$7.50 a gallon. Yeah. It pinged off the upper limit of the credit card limit, and so I'm like, oh, I'm not going to run it again. I'm taking 2/3 of a tank.
Oh man.
It's like crazy here.
Yeah.
So yeah.
But if you look at it's just so wild how resilient the stock market today's Wednesday when we're recording this, the 8th, the market's up 2-3% today.
Well, I mean, let's call a spade. I think that, and not to get too political, but I think that what Trump did on Easter was really odd, and people were like, what's going to happen? I mean, he was posting some really crazy things on Truth about like wiping the civilization, using profanity. There's a lot of stuff where it was like, what's going on here? But they came to a deal. Now, if that deal lasts is to be seen. But to my understanding, the Strait is open. There is a $2 million fee. It's split between Oman and Iran is what I was reading. But ultimately, that's a win, right? So like the stock market, I think that's why you're seeing, I was just reading before we came into this meeting on CNN that, gallon or a barrel or drum of oil has dropped down under $95. So I feel like it's like something's happening. It's not we're both at war, nobody's talking and nothing's happening. It's like 2-week ceasefire, Strait's open. This is a win. I think this is a political win for Trump.
Well, and now with just a one day of hindsight, he tends to do all of these crazy comments, and it's almost like, like it sounds like a joke or like out of a movie, open the effing Strait, you crazy bastards.
Yeah.
I just can't even imagine any other president in the entire history saying things like that.
Yeah.
I don't know. It could be wrong, but
there is a political philosophy like Nixon, Kissinger, they had kind of done this like act erratic in order to get what you need, because if your opposition thinks you're erratic, you might do it. I did hear that like they actually spotted bombers flying over the United Kingdom yesterday. So like, I think they really postured. He's sending really crazy, tweets.
I wouldn't call Trump's bluff on that.
I think, and I think that's kind of what happened.
Pretty crazy to be like, Trump won't do it. I don't know.
Yeah, I mean, I don't think war is good. I'm not like a huge fan of what's happening over there, but ultimately the main pressure, the main push in order for this to look like a political win was to get the Strait open, and today the Strait's open. And there's a 2-week ceasefire, and I think we're seeing markets resound to that. I think that's where you're seeing that positive uptick.
Yeah, and I was just reading right before this that the Strait is like quasi open, like limited on what ships go through,
it's
how
15
many
or 12 a day or something like that.
And we'll see if that
they want $2 million
continues.
per tanker.
But I was wondering,
crypto.
We should look. Is that what it is?
Supposedly, I'm not sure about that. It did say that somewhere, like it was written that way, but I just got laughing. Like, I wonder if they actually are going to do that.
I'm curious what's the value of the shipment of one of these tankers, though?
Oh, I bet we could find out.
Like $2 million sounds like a lot of money, but
oh no, I bet you it's significant, hundreds of millions. Yeah.
But I think I was watching something too. It could be kind of strategic in that Trump might not care if there is a tariff or a toll, I should say, on that oil. It'll drive up prices and then maybe make people more reliant on cheaper U.S. fossil fuels. And then that creates demand for the U.S. dollar, for treasuries, which then keeps us as the world currency and allows us to be a debtor nation and, the superpower, so on and so forth. So,
wow. They call it VLCC. A very large crude carrier is 160 to 170 million per ship. A ULCC ultra large is 240 to 255 million per ship. At $85.
So $2 million passage is like,
it's a 1%.
Yeah,
it's not too. I figured it was something like that because it was all the news.
Seems like
$2 million.
It seems like a lot, but like on face value. But to your point, yeah, it's a big economy of money going through there.
Yeah.
So take the toll and like use it and reboot your government.
We took over the Panama Canal, correct?
And we already have Panama and Venezuela.
We charge a toll there.
I don't know exactly how it works now.
That's going to increase.
We got to get sponsored by Perplexity. Oh, man. What an interesting time. I also feel like there's this culture of watching the news and making trades. It's like the internet generation, which is us, is now actively trading on Robinhood and whatever. And so it's so tumultuous. And I kind of think that leads into us in general of why we love mobile home parks and real estate in general, because it's not like that.
I agree. I mean, I think I get, staying up late sometimes and you're like reading the news and you get sucked in, and then you got to realize that it's just all noise. And I think if anyone is like stressed and constantly staring at your stock portfolio, like that should be your first sign that you should probably like de-risk. And go into
the tech side is so crazy right now. I was talking to a friend / client the other day, and I made a comment like, I've never been able to make sense of like Elon's stock, any of them. Mm-hmm. And then I went home and I was just like researching like what was the history of his stock price on Tesla and like just the price per earnings ratio, and it was like from like 35, which is pretty high. It's now at 350.
Jeez, price per earnings.
And it's just like what, so like. That's just the realm where like Buffett and those types of guys, those good old boy investors, they just never would go in those speculative growth markets. Now, people have made a lot of money. Good for you if you have. Like, it's all good. But like, there is an element of like, you got to make sure you're not in the casino and the whole house of cards is going to fall.
Yeah. And Buffett's sitting on a ton of cash right now too. So he's not buying really anything.
Well, and like Google dipped, over the last year and a half. He loaded up on Google because Google seems to have more moats around a lot of the other tools and AI and all of those things. But yeah, actually, I was going to say something about like, we're laughing and making maybe a little bit, too much fun of this whole dynamic, but we tend to lean on laughter versus like crying. We'll go to like in the office, we'll kind of make fun of just to keep sane.
Yeah.
Because it's like we interact with a lot of people with a lot of money in the markets all the time. So just know, don't take it personal. We're just having fun, laughing it off versus like going into fear and being scared.
Exactly.
Yeah, and we're laughing about getting a sponsorship from Perplexity. I mean, what's happening over there is not funny, but we're just shooting the breeze right now.
Yeah. I mean, it's 80 million plus people. Like, it's something that's serious. And you got to like, so that's where Trump's not going to most likely wipe it off the map. But like, he might be crazy enough to do something.
Yeah.
So like, I get why they should make a deal.
Well, you guys saw that bridge that they cut in half? I think it was F-35s, like struck this like main artery into Tehran, and they cut the bridge completely in half. Like, you can't drive on through this main
but they
way.
didn't hit the pillars, which are the more expensive strategic.
They intentionally just hit the span.
The span in the middle, which is quick and easy. I mean, sure,
quicker to fix
versus hitting those pillars strategically, right? And I think in general, I do think Trump, to his demise as well, the stuff he says, I don't necessarily think he believes it all. I think he would love just to have the Iranian people and that regime, prosper, right? And I do think he has a good heart, like in terms of he doesn't want to just go in and blow it up. And I think you're right, Tide. I think it's more of like, come in with a big bat, and try to scare people into negotiation. But I do agree, though, if he does get back into a quarter, he is no one can predict him, that I wouldn't put 100% confidence that he wouldn't do something wild, like start hitting their power plants and everything like that. The thing is, too, if they hit the power plants, Iran has said very vocally that they're going to go hit all the desalination plants in the Middle East. And the Middle East would, like, we're talking like UAE, like, all those like major like allies. And you hit those desalination plants with those $20,000-$30,000 drones. I mean, they run out of water in like a week. It's freaky. Yeah.
But what's really interesting about that, though, like, because I've kind of heard that side of it too, and I'm not an expert. I'm just curious because it's like you get these reports where it's like their capacity to extend attacks is dropped like by 95%. It's like almost 100% of their strikes are being stopped. They have this limited power. There's so much positive happening on our front. Are they capable of doing that?
I think so. They're only $20,000-$30,000 drones, and Russia can supply them with those, and China or whoever. And I think that they do have a pretty massive fleet. I mean, like, they probably have been preparing for this for the last 30 years. So those underground bunkers. But that's the thing. It's like, you're not dealing necessarily with like the Ayatollah, these people like that are not necessarily rational people. And it doesn't really take that much. Like, yeah, they have ballistic missiles, but say we get all their ballistic missiles out. If they still have fight in them and they can just keep launching these rogue drones that are $20,000, $30,000 and hitting like things like desalination plants and continue to mine. It's just
like unsuspected, like
guerrilla warfare.
Yeah, it's like these weird like bird drones. They fly over real slow, and you just like nobody's suspecting them. It's not a rocket, so it's just odd.
Yeah,
like really odd.
And just with the Strait even too. I mean, it's just like the thought of them having mines, and it's all very cheap. But as long as you got fight in you and you can keep causing havoc, the worst thing is that these ballistic missiles that we're sending I forget exactly what they're called, but they're defense missiles. They're like $20 million that they're using.
Every time a drone comes flying over the border, they smoke it with like a $20 million anti-aircraft, or whatever it is. the what do you call those units that are like security only? They're basically defensive missile programs.
Yeah, they're like the Iron Dome, and Israel has a bunch of them. We have a bunch of them. We've supplied Ukraine with them, but they're $20 million a pop.
You checking out javelins?
No, they're not javelins. They're even more expensive than that.
More than that. Yeah. It's wild, and so it's in everyone's best interest to de-escalate and make a deal.
I think
without question. So. Yeah, without question. In all cases with war, like we don't want war.
No, and I think too, like if this war continues as well and gets worse, I mean, I just think that like with oil going up, gas prices, people are already squeezed so much. It'd be terrible for everyone. So it's like I just think if we can just come to an agreement, hopefully there is some sort of regime change, some level minds there, and then we can just like move on, and it would be the goal. Like this would be terrible if this goes on for another 6 months.
So an interesting like security risk that hit US was Starlink is used on, they found that Starlink was being used on those drones so that it could connect to the internet and you could control it.
Yeah.
The enemy could control those drones. So they saw this and they turn around and look at the US and all of private aviation, just from my like more hobbyist vein. And we use some friends' planes for business travel. Everyone's running Starlink now. So they're like, oh, and they turn around. How many are running Starlink over here? And it's like a map moving of Starlink. So they had to like cut everyone's Starlink and completely change the regulation for Starlink in aviation real time. This is like the last few weeks. When it first kicked off, maybe like the first weekend of the Iran conflict. So basically, I'd say Elon and Starlink, they didn't realize the depth of the disruption they were going to have on in-flight Wi-Fi, but it was way better than all of the other previous like
options.
Iridium connected,
because it's like $50,000.
It was like $50,000 a year. The airlines were always getting way more screwed than that. And so it was like, we can
never works. Every flight I'm on, it doesn't work.
It's horrible internet. And so Starlink all of a sudden is like the new gold standard.
But was it confusing?
No, it works great.
No, confusing like our ability to shoot these things down or detect. Because
is it terrorists or is it a local pilot?
Nobody. All of a sudden now they realize like we have a huge security threat. You can't tell. Like you have radar and you have like these registered aircraft. You're supposed to have certain a registration which your computer kind of interfaces with radar, but out in the country, like if you can fly an airplane with nothing, and then all that they're seeing is this Starlink that's tagging up, with the active satellites. Moving. So like they could fly drones right in, or they could boot them up here, like if they have cells here. So they basically said sorry, but we're starting like the next day, like they literally one day. They canceled and had to have everyone register. If you're using your Starlink on a plane, you had to register it with the FAA. It became a whole new process. And then they went up from like $60, $80, maybe $100 a month to how fast are you going? So it was anything over 87, you're aviation. So in a car, you can stay on it. But if you go faster than 87, it's $250 a month. If you go faster than 300, it's like 500. And if you go faster than 400, it's like $1,000 a month. And you had to have it registered and everything. Like
with
all
the tail number,
all the private jets, everyone's running. I was going to mount one in my plane just because it's like, I'm out like camping or running around in the desert. I can use it as like an emergency response. I could call somebody.
Yeah.
With just normal power out of the plane. So I was going to do that. And I'm like, well, I'm normally going faster than 87. I'm doing like 100, 120. And then they just cut you off. So I'll maybe keep it and leave it in there. But like, it's really interesting. Like this whole conflict created like this mass change in aviation internet.
That's smart. Well, that's smart though that they did that. If it's for defense, I mean, it sucks for sucks for you.
You got to do what you got to do what you got to do. And it's all like the guys like we're running around and you're getting perfect Wi-Fi and like everyone's stoked because it's like $60, $80 a month. It's like, this is a steal. Yeah. And now it's just not that good anymore. Pricey. It's still good internet, but yeah, it's just crazy how it impacted several things. And just a weird story I figured I'd share about like the war and the impact.
That's super interesting. I just think in general we're just really in an interesting time where I think it's the best. Like you're going to be served really well, and I have to tell myself this. This isn't me like trying to give somebody else wisdom. It's like me talking to myself as my prep talk. Like you really got to turn off the news. Like I enjoy the news, but I haven't been watching it because I don't even know what's real and what's fake. Going back to what you were saying, and then also too, it's just like it kind of like it reminds me of like when COVID first happened, like watching the news, how it gave you like anxiety or stress. So I just have turned all that off. I've even thought about turning off all my social media and just like, hey, just staying off all of it. That way I could focus on like the main task at hand, which is really what's going to serve all of us, you know, not even just talking in this room, but like whatever you're focused on, you know, whoever the listener is, like you're so better served, like just focusing on the things that you can control in life. And I have been talking to a handful of just like younger people, and it's insane how wrapped up they are in all of this stuff, Jeffrey Epstein or whatever it is. And it's like, it's driving them mad. And I'm like, oh my gosh, like, what are you doing? You should just be like learning things that are going to serve you and like make you a better at your career as a husband or a spouse or as a father. And so that's what always kind of sucks about these types of moments is that the fear sells, and that's what is getting pushed everywhere. Plus AI too is nuts. Like, I don't know what's real or what's fake. Even like you go on X and stuff. I just feel like I have been like, honestly, like brainwashed the last couple of months. I'm like, I need to turn it off. But that's just me. Like, I sob, you know.
That was always my secret. I've never really got on it.
Smart.
I read news and stuff like Zero Hedge, and I make sure I keep
Wall Street
informed.
Journal, stuff like that. That's great.
But like, you just have to keep out of the noise.
Yes.
Noise versus signal.
Yes.
You know, you got to stay on signal.
Yeah. I was watching PBD last night, and they were showing like the Iran response to his tweets, and they like had uploaded this video showing there's this like new super data center in Bahrain or one of those places, like multi-billion dollar, I think it's $30 billion like facility. And they like uploaded like this drone video of it. And then they showed like all of these CEOs that were meeting there. It was like OpenAI, all these guys are like shaking hands, and it was like showing that they're American and stuff. And it just gave me the creeps. It's like, I understand that we're at war, we're actively doing something, and you would expect that there is some type of response, but just seeing the response of them being like, hey, like right next door, we've got this super important thing to you guys, we're going to destroy it. And like, they were talking about how much enriched uranium, how many bombs that equates to. And like this is serious. This is crazy. We might have, like, we don't know where their enriched uranium is. We don't know if they have some type of thing. Like, I know in the 60s, you know, that was kind of when everyone was like concerned about the Cold War and there being nukes and things happening here. Like, that's when kids started training, going underneath the desks and stuff like that. And like, I just would hate to see my kids grow up in a world like that, where there's a concern that their school might get blown up or something terrible happen. And yeah, it's not a good thing. Pray for peace.
Yep.
Agreed.
And you have to have some faith. So, okay, we were getting, initially when we all sat down, we were having fun kicking around winners and losers of the next 10 years.
Yep.
You know, and I think that's, you know, we intake a lot of multifamily real estate, different shows that we're trying to continue to stay sharp on kind of the global marketplace, or the US marketplace of real estate and where you can get yield. And, you know, so we like to stay sharp on also it's competition for us as we grow and expand. But where do you guys think the winners are going to be and the losers over the next 5 to 10?
Well, I feel like this was actually kind of a hot topic at IMN that I was just recently on a panel, and we had some really big companies, really big groups that were there talking about kind of the future. And the thing that kept coming up, which was interesting for me, was that operations is going to be something that's really focused on in the next 5 to 10 years. So if I'm thinking about how to answer that question on who are going to be the winners over the next decade, it's going to be the groups that are not only able to buy assets, but are also able to squeeze the juice from them effectively, right? Mm-hmm. So it's like over the last 10 years, we've had a lot of institutions enter the space, and that's all over the place, right? And so now is going to be the time of like, who can actually run them, right? Like if anyone who has a lot of money can buy real estate, the question is, can you operate it for the long term and really efficiently use this asset, especially if you paid up for it? And so I do think that's kind of something that we're going to see over the next 5 to 10 years, the operators.
Amen. You got to be able to operate, increase revenue, but not have your expenses expand with it.
Blown.
Yeah. And I'll just build off that. I think that's spot on. And then just losers, things that have a high CapEx or like R&M component, like percentage of revenue, right? Like office, right? I mean, office got beat up because of this work from home. A lot of this stuff is older generation, right? And so it just like the floor plans, it just doesn't fit the kind of consumer today, right? That tenant. So but I think it goes beyond that because office is an easy one. There was an article yesterday talking about that things are trading at 90% below the last like purchase price, right? So like 90% discounts,
Wow.
like in Denver and places like that.
Man.
It was in the Wall Street Journal and like the office sector. But I think it's like more important than just that. Like losers, anything that like has a lot of like percentage of CapEx built into it. So cost as a percentage of CapEx to revenue. I think that those things are going to get beat up because it has to do with like what we're talking about,
Like data centers.
Data centers, I think, yeah, as they get overbuilt, exactly. And I was listening to something like, I guess every like 5 years or something like that. I'm probably going to screw that up, but like the tech is no good anymore. It has to be like rebooted. So there's just this massive CapEx component.
It's
So like,
massive, hundreds of billions of dollars that are already thrown at this.
so like, all right. So like if I'm, well, we are investors but I am biased, but like if I wasn't, right. If you're not like, hey, I don't like mobile home parks, right. Cause that's where I'm going to go as well. But like anything that has a high component of CapEx, like a high expense, I could even say high rise apartments with that, unless, like anything that has like a very high, like
supposedly
CapEx.
The downtowns without walkability, the institutions go in there every year, every time, every cycle and get crushed. Cause like people in theory, when it's brand new, it's sexy. Everyone wants to live in the downtown. But if there's no walkability and it's not like built out like Manhattan where you can just go to a restaurant down the street, then it doesn't sell well. It doesn't lease up.
Nobody wants to live in the downtowns. I mean, just think about any downtown that you've recently been into. San Diego, we're in San Diego. No one wants to live in downtown San Diego. Yeah, homelessness. You don't have good retail there. You don't have good walkability like restaurants. No one's working there. The office is going back to my point. No one's even there. No one's even
90% discounted right now. It's empty.
I mean,
how crazy is that?
Like Phoenix, right? No one wants to live in downtown Phoenix. They all want to live in Scottsdale. If you're in San Diego, you want to live in like North County, like, Sereno Valley, La Jolla area. Like that's the office market. That's the retail market.
I do think that this specific conversation is very market contingent, right? Like I'm sure places like Manhattan or, San Francisco, some of these places, like, because I think San Francisco's having a rebound. That's kind of some things that I've been seeing.
I lived in San Francisco. No one lives in downtown San Francisco either. Or like, it's not like no, there's tons.
I feel like you have to live in Oakland right now for $6,000 a month in a studio.
There's hundreds of thousands of people that live there, but that's not where you're attracting like top rents, right? But like San Francisco has rebounded. The difference between San Francisco and Manhattan, though, is that they have, those were the growth hubs forever, and they've built the transportation's there, the retail's there, the restaurants are there. So they have all the infrastructure. Phoenix, San Diego, Dallas, like they don't have that built-in infrastructure that makes a downtown property for just a person that has options, I would say, and that's going to go live in a high-rise expensive, like to want to be desired to live there. They're going to go live in
if it's a more suburban MSA, I agree with you guys, but I do think that there are some cultural hubs and places where people want to live in the downtown area.
Yes.
The point being that those buildings right now are struggling.
Yeah.
Like that's just like the lease up because they overpaid for the cost. Like they're selling for below what they have in them. That's happening. Right
now. And so where's my winner? Anything that has low CapEx, low expenses, where you can get rent growth, right? And I love shade and shelter. So like residential. So like mobile home parks, right? Like the percentage of CapEx compared to the revenue is the smallest against basically any other residential asset class. Your expense load is lower because the expenses are just creeping as labor is getting more expensive, as costs are getting more expensive. You just want to find places like, where can I get yield? Where do I have a foot on the gas on revenue, and where can I mitigate as much as possible these increases in expenses? And that's going to get you the best overall return. And so that's why I think like mobile home parks, I just don't want to have things that have a lot of costs associated around them, because how do you even underwrite for what costs are going to be in the future? You can't do the lick of the thumb 3% on expense ratios anymore as you grow a 10-year discounted cash flow. It just doesn't work.
No, No. And there's a lot of interesting things, that weren't even in consideration, like insurance, where it's like, who knows where that's going? Energy is getting so expensive. I think also the world's getting more expensive just in general. And so anything that is a more affordable option, in our case, it's affordable housing, but things like fast food, I bet that that's going to crush it over the next 5 to 10 years, because as things get more expensive, people are going out to dinner less, these types of scenarios. Like anything that is a necessity and is on the more affordable side, I think those are going to be the things that we see win.
Yeah, like the Dollar General popping up everywhere.
Yeah.
Yeah.
All kinds of stuff like that, home goods.
Industrial that's like last mile fulfillment. I think that's kind of cool.
I do think we're going to continue to see a lot of ordering. And so any type of service that facilitates that is going to be big. Like, it's crazy. I remember when we first moved into our neighborhood, we were kind of one of the first houses that like had lots of Amazon deliveries and lots of things showing up. Now it's constant. There's multiple Amazon trucks sometimes on our street, it seems like, and like I have things, it's at nighttime and you realize, oh man, I don't have hair gel for tomorrow or whatever. And it's like, I'm going to order it and you wake up and it's there at 6 a.m. or whatever. And you're like, wow, 4 a.m. to 8 a.m. it'll be here. It's just a different time. So I think things that facilitate that, any technology that goes with that. So logistics companies, any type of things, along those lines, I think those are going to be winners over the next 10 years.
Mm-hmm.
Yeah, supposedly there's a robot delivering now. It's like official.
Like a Waymo Amazon kind of thing?
Well, yeah, it's like a little robot. I don't know how it's deployed or anything, but it's like a cooler.
Oh yeah, they've had those. Yeah. They have them in New York and I think in LA too.
LA, I heard recently.
Yeah.
Yeah. So yeah, and somebody was like, "Oh, going to hell in a handbasket." I'm like, you're lying in the sand as a robot cooler coming to the door. Like, I don't know. I mean, I get it. It's new. It's a new way of life, but like, I don't know. It doesn't seem like it's that crazy. Scary.
We're interacting with AI a ton, and we are seeing some interesting things happen. I had a really interesting conversation about due diligence with a huge group, nationally operated. Top guy, just ended up at dinner with him, and I'm talking about AI, and he's like, honestly, I'm taking notes. We're going to implement some of the things you just said. I think a couple people might lose their job. So I do think we're going to see that. But on the flip side, the amount of data that comes in from AI collecting all of this information and doing all these things creates more follow-up, which results in currently more people doing work. So there is an interesting part about AI that I think will be fun to watch, which is I think AI is going to displace jobs, but no one's talking about the jobs that AI is going to create. And I think that's something that, to keep an eye on.
Yeah. And I agree with that. I personally, I don't think that it's like the Industrial Revolution, right? Like it just, people are just going to re-gear and retrain, and there'll be jobs that no one would have even thought are jobs today that are going to be the jobs of the future.
If I'm not threading t-shirts, what am I going to do?
Well, like, can you imagine the first time they had like a good drill versus having to do it? Or like my dad had one of those, like, you have to like shimmy it in and out.
Yeah.
And it like goes through, it's like a little weird drill.
Oh man.
Like just think about the leverage you get we've already had over the last 150, 200 years. And it's just one of those new levers, new tools.
Yeah, and I mean, if anyone is listening to this and would be curious how we're using AI, we've launched Claude across our entire company now. So we have like a corporate subscription, corporate level, and then Michael on our team, who's our AI savant, has built out Comfort AI, which is built on the back of Claude and some other programs. And we've intertwined all of our information, and it's like amazing. It is so cool what it's able to do. And I have an app on my phone now, Comfort AI. And so it has.
I didn't even know we had that.
Yeah.
Nice.
Yeah, I know, like things every day. Just like, hey, we got something new. And I'm usually like a later adopter on technology, right? And I just sat and played with this for like, 2 weeks ago. And like, I was like telling Michael, I'm like, holy crap, this is so helpful. It's insane. And I won't go through all the things that I'm using it for, but it is, I wouldn't need to hire like a junior person to do some of these things because I'm now doing it. So that's, I guess, my fear, like, is that how do you like train the next generation of, I think like college grads coming out now have like a really challenging time, because I think there's so much built-in efficiencies on, let's just call it grunt work, that can be done by AI. But in order to build the skill set to know that and the knowledge, really, the expertise that whatever that AI is spitting out at you, you know whether it's correct or wrong, and then how to prompt it to get it to what you want. But you've had to build up some sort of foundation. And generally, you've done that over 10 years as a junior, like doing that grunt work where you're like, oh, this is interesting. Like, and you're asking the questions and setting up a meeting with your boss. Like, I hope we don't lose that, because like that's how you train people to then be able to then leverage AI and use it strategically. Because I don't think it's at the point now where it's completely like agentic or whatever they call it, where it's going to just go out and do my job exactly for me. It could get there, but you need a real person there that actually understands what you're trying to do, like, or what it's trying to do, whether it's math or whatever. You need to know, like, oh, so when it spits it out, like, that's incorrect. And you like prompt it, oh, good catch, Ben. Like, yeah, let me change that, so.
Good morning, Benjamin. You have to make 100 calls today. Okay, so it's actually kind of giving me, listening to you guys, it's giving me like a new framework for this like opportunity zone for like the youngsters. And I feel like there's a Y in the river right now, which is if you're computer oriented, you should really understand how to use AI.
Yes.
Like
sure.
if you like computers, and like you're interested in that realm.
Or just technical.
I'm personally not interested in that, but I'm interested in understanding how the world works. And then, so the kids, if they are more interested in getting their hands on stuff, go get your hands dirty.
Yeah.
And learn
Trades.
how things go together and work clean and build things, put plumbing together, go build and work in construction. It doesn't matter where, because they're not going to be able to build robots quickly to assess those types of real world. They're really odd. Like I have a leak in my house right now. Good luck figuring out how to have a robot do that. Like we're cutting holes, or they're doing flashlights. They're looking around. They're like, oh, you got a little mold here. There's like, it's a lot of data that somebody has built up over a lot of years working in the trades. So now what every business is going to need is both.
Yeah.
You need somebody that understands how the real world materials, hard assets go together. Building, setting, like for us, it's the building of the homes, it's building apartments. It's like you need the trades, all of them, but then you need a good couple of AI guys in your crew that are going to make sure everything across your entire platform works. It doesn't really matter what business you're in. You're going to need the software side, and then you're going to need the boots on the ground.
I think we're going to see a major shift. And on one hand, I get where you're coming from, but here's the sad truth. A lot of those grunt jobs will be displaced. And we've been in this era of like, I remember when I was in college and the conversation was like, you can make 6 figures as a social media manager. Like all these goofy jobs where people make a ton of money doing nothing on computers is gone. Like that's just going to go away. Now there's going to be a financial incentive to get into jobs like the trades where they're hurting bad. Like I have a friend who's in HVAC. They cannot get guys to do HVAC work, but he makes a killing. And so people are going to look at it where it's like before you could make a killing as an attorney, but now all of the grunt jobs are filled by an agentic worker. And so now they need less attorneys. There's going to be less financial incentive. There's going to be less job opportunity, and the values on them, I think, is going to drop. So you're going to see jobs like attorneys, CPAs, certain things like this that are very regimented that a LLM or large language model can do quickly. Those types of jobs are going to become less valuable. But then we're going to see a pivot into the trades. That's kind of what I think is going to happen.
I agree with all that. But just as that why too, like it's not just trades. If you went to school to be an attorney or like just business, I think that like understanding how things are built, let's not maybe make it into the physical world, but like if you even ask along
engineering and all that.
But it's all like they'll spit a bunch of stuff out of you, but like really understand the nuances of like how things can go wrong. Like what about this? Like it's not just so black and white that you could plug it into Claude. Give me like a random example. I don't know. Like
I got a good one. I was just kind of, meandering, thinking about maybe doing a little add-on to my house. And I was like...
But we're going back to building, though.
No. But I'm going to explain, like, this is something where I feel like an architect or an engineer or an interior designer...
would have done.
Would help me. I was asking it to kind of put it together. And, like, it did it, but it was such a computer thought, and like it didn't make sense. It was gibberish. It was like, this is not where it needs to be.
It's not there
you
yet.
still need these types of people.
Yeah,
I think that's what you're getting at.
Exactly. Like just like the nuances of how everything is not just so black and white.
Those people will be able to use the AI tools to
Correct.
scale and not need let's call it the entry level software manipulators.
Correct.
And so I was just pulling up what's the largest grouping of job roles that's been displaced, and it's customer service call centers. Like, yeah, that's gone. We already have a really sophisticated, like when you call for home sales and that line, like it chats with you really clean, but then dishes you off to the right person. Entry level tech software roles, I feel like that's in that ballpark. Like if you had a younger person that kind of drafted things for you as software and maybe put together those like interior design looks, you could just do that pretty fast, as your own, business. Like just keep it solo, not have to hire somebody. Content and copywriting, writing articles, or like, I see so many clickbaity little things. Like if I do go on Twitter, there's so many like, like look at this, and it's like a teaser, and then you read these articles, and it's like, okay, it's interesting, but like who wrote this?
Yeah, it's just AI slop.
I don't even think that anymore. I know it's AI. I'm like,
Yeah.
Well, no, I know, but you know what I mean? It's like, once you read it further, I feel like, okay, yeah, moving on. It's just odd, but that's there. Yeah, that person's
Sometimes I
probably pumping
catch
out
myself
content.
and I'm reading AI and I know I'm reading AI and I keep reading it. And then I'm just like, why am I reading this? It's like,
Legal research assistants.
yeah.
So like grunt legal, which I had heard that.
But going back, just something that, and I don't have a ton of context on this, but I feel like we have to
you
cover
better be
it.
an expert or don't talk about it.
Is the private credit market, because
Oh, that's right.
Yeah,
Yes.
because I was listening. Who's the guy that you turned me on to? He's the Big Short guy.
Steve Eisman.
Steve
The
Eisman.
Steve Eisman report for a weekly wrap is really cool.
Yeah, I like that guy.
He's the big short guy.
Yeah, and so
Which one?
The guy, this is the
Steve
guy
Carell.
that Steve Carell played.
Okay.
Where he stands up, he's like, 0! You're going to have 0. and he was right.
But what he's saying right now, and he's doing like back to back, and he's harping on this, is this private credit crunch that's going to happen, and like this is the canary in the coal mine. But the one piece that I will tie back, because it's similar to what we're talking about, is that all of these big funds that have been raising money in private credit, they're like, and they're mega funds, right? But they have like a 20 to a 30% allocation to software companies. And software companies are the biggest, I would say, like risk, like across kind of global like markets, because they are the ones that AI can interrupt the fastest. Because like think about like just a big software company, like you have to staff it with coders that write code, that know Python and SQL and all this stuff. They get paid $200,000-$300,000, even more, right? They're all in San Francisco or New York. It's just a massive business. And then you go out and you start calling businesses and you just help give them some sort of CRM or whatever it is to help scale their business, solve some of their problems. But then now with AI, it's like, we've built websites, we've done all this stuff, and it just codes it all for you and just keep prompting it. And so software companies have been getting hammered on this, in the equity markets. But the bigger canary is that there is a massive amount of private credit that is lent out to these either startup companies or large companies, probably more startup, because large companies are going to be able to get more like bank, traditional type of financing. But that those companies are going to take big write-downs and might go out of business, and then cause this kind of contagion where you might, where no one expected it, right? Because
So break down private credit. Like I kind of get it in concept, but why would they loan money to those companies?
Well, so private credit is really.
Like, do you know what private credit is?
I just would assume that if you have a basic, they probably have a higher threshold than a bank, and the whole business model is that they are lending the money and making the interest off of it. So
and it's meaningful interest. It's what it's not hard money, but it's probably like 8 to 10%.
Yeah, 8+, right? So 8, 10, 12%. And so I was kind of worried about this industry. So where private credit's been around forever, it's a great asset class. Like, people invest in it. And like private credit, you could think about investing in privately, right? Private, right? So private. So they're essentially
Private.
raising money from institutions primarily, right? Pension funds, sovereign wealth funds, you name it. And then they're going out and lending that money to either real estate. So you could do real estate, right? Or you could do it to companies. You could do it to a lot of different things. But for the purposes of here, they lend it to companies. And it's mostly like startup and growth type companies that are private as well, that don't have the traditional financing means of being able to essentially get issue out what's it called? Not CMBS.
Well, they don't have collateral.
Exactly. They can't just go and
But
collateralize.
they have good operational revenue streams and it's growing.
Yes.
So it's decent collateral, but it's not real estate backed. It's a business.
Exactly.
And maybe how old is the business? It's not a startup.
No. How old is the business they'll lend to?
Give me a breakdown of because I feel like if it's a startup, you're not going to be able to get that private credit.
You could.
Really?
Yeah, you definitely could. Yeah, if you have some revenue, right? So they're going to look and say oh, you're a startup, but you have some revenue, you've raised some money, it's meaningful. You need some debt to continue to grow to get you to the next equity valuation. Then we get paid back, right? And then we're happy and we charge you our 8 to 10%.
So it's all of the startups that are maturing towards some type of a growth moment.
Correct. Yeah, like private companies primarily. And so
but they're higher risk.
They're higher risk, and that's why you get a higher return, a higher yield on it, because you could just go buy AAA debt for Apple that's going to pay you 6, right? Or a 5 or a 4.5, but it's backed by Apple's balance sheet, right? And but they have tons of revenue.
That would be a good one.
Correct. Correct. But then if you want to get out on the risk spectrum and get higher yields, then you have to then go into private credit. So they're all these guys, I don't know, Apollo, Carlyle, Ares, any of these ones. The big ones like Blue Owl right now, that's in the headlines, but they go out and they raise all this money from institutions, and then they lend this money on their behalf, and then their institutions get that return. Now, why it got so popular was really after is really from just going from a scenario where it was basically rates were zero, right? And it was getting bank lending, getting any sort of lending was really plentiful. Right.
Yeah, you didn't need credit.
Yeah. So private credit wasn't a hot industry. People were still doing it, but it wasn't really a hot industry. What happened was when the interest rates started to increase, in 21, 22, people then started to go out on the risk curve to then go get yield, right? Because they weren't getting yield in equity and banks and all these other folks kind of tightened up their balance sheets. So it really opened up the opportunity for these private credit funds to lend meaningful, have deal flow, and go raise billions of dollars. Now, what Steve Eisman's saying is that he thinks that there's going to be significant write-downs because they're not held to be able to mark-to-market their valuations, that there's a lot of bad debt out there that's never going to get paid back, but they're still holding it at par, right?
Well, hold on. So let's zoom out. You're the sharp guy on this. Make this
not my realm though,
but walk us through this, because the major concern when we say there's a canary in a coal mine, we mean that catastrophe, right? Mm-hmm. Economic catastrophe. So the assumption would be that all of these large scale institutions have adopted this private credit. Private credit fails and it undermines retirement portfolios across the country, right?
Yes, but then it's the contagion effect, right? So
everyone starts selling. What is contagion? Just to be clear.
And then banks are intertwined in this as well, because say I'm a really good software startup. Valuation on my last valuation was call it $5 billion, and I have this private credit fund, and I'm not doing that well. It's not just that I took private credit money, right? Like private debt. I also have a line of credit through Bank of America. I also, you know what I mean? So it's all that contagion. So then boom, there's a write down there. Then Bank of America is has to take a big write down, and then Bank of America stock that gets out. So then people are selling off the stock, and then Bank of America is lent to Deutsche Bank, which, you know what I mean? So it's all that contagion. It's the same thing that happened in the 2008 financial crisis. It wasn't the mortgage issue spawned across across the world. It wasn't even just the United States, across the world, because there's so much leverage in the system and there's so much interconnectedness that nothing happens in a silo, but you need something big enough to cause.
Yeah.
That's the canary in the coal mine.
And it's big. It's like it's like roughly call it like $1 trillion.
Yeah, so I just looked it up on what percentage of institutions are holding this private credit, just to kind of get an idea of that. And just we've had this conversation multiple times where I feel like the housing crisis was different because it is like so many people touched houses. Like Main Street was touching houses, your grandma was touching houses, and they were not qualified to pay for these houses, right? And so the effect of that was so big. Private credit in this scenario on software and tech companies, it doesn't seem to me to be big enough to be like catastrophic. Could it cause a downturn? For sure. But do I think it's going to like put like millions of Americans out of jobs and cause, widespread heartburn like the financial collapse crisis? I don't think so, personally.
It's for sure different, but the dollar volume is potentially bigger by maybe multiples.
Let's check that, because I don't know. So right here, I'm looking at it. It's saying that they've targeted 5+%, but on average, it's 3.6% of these pension funds. 5% of insurance companies.
Well, no pension fund's going to allocate, but 3.6%, that's a meaningful allocation for a pension fund. Like in general, just to like have to an allocation.
Banks pretty heavy into it. So like then the banks sell off the stock, but also they've gated. So if you have money in them, in any of these funds, which is like all the names he said, like Apollo,
Blackstone.
Oh,
BlackRock has one too. Yes.
Yeah. I think they all gated now.
Yeah.
Meaning if you have money in them, you cannot sell it.
Yeah.
So they're requiring only a certain amount to go because it will break the fund. But if they all sell off, and then what happens is they actually incur losses. So the private credit default rate has climbed to 9.2% by the end of 2025.
Really?
Yep. Which is big.
Yeah.
And it's up. I think it's up more than that now. I was just trying to find the current.
You take this into account. You take maybe like all of the CMBS and just like Fannie Freddie multifamily
losses,
right? You take like war outbreaking, like
it's enough to peak the market is the bottom line. Everyone goes into fear and doesn't just sell off of these; they sell off of everything.
Yeah,
yeah. So I just looked it up. In 2008, it was already 5 times as big as the current private credit market is today.
What was the dollar volume?
Almost 10 trillion, and all of private credit right now is 2 trillion.
Yeah, but
wow, I didn't know it was 10 trillion back then.
Yeah, and
that was massive.
But going back before like 2008, it
was 60% of the debt market was the houses. Like this is not the same. It's bad.
It could create the sell-off, the whole sell-off.
Yeah,
I think it's like the little snowball off the top.
I mean, because like let's look, and we don't know the exposure. We're picking one thing, like it's private credit, right? But we don't know how many banks have.
No, they're all in it. They're all in it.
Yeah, they're all in it. That's what I mean.
And then it's just different allocation.
So that's what they're telling you. They're just maybe pulling like private credit funds, like that's that number. But then you got to think about all the contagion. How much exposure do banks have that to these companies or similar companies or other banks that they have liabilities or assets with that have exposure to this? So that's what I mean. You don't know until the chips fall to see like, okay.
Yeah, like the math's not clean on how much we can find quickly on
correct.
What's at risk here is the point.
Claude's agreeing with me.
Yeah.
Big time.
Because like what's the
all the context that you fed to Claude. No,
I wonder what the market cap is of software companies, whether they're public or private. Like that's a huge number.
There's the millions of people that get displaced. All those software companies go under.
Yeah.
I mean, because like those little ones, they're probably not.
But then they're going directly into AI development and things like this. Like there's this huge industry that's emerging now in tech.
Well, but AI is starting to falter too. So I do think I'll play on this because I actually think it's like a little bit of that Death Star moment right now. If Trump can get Iran and this whole thing to settle down, then the chances of like throttling through this successfully could work.
Mm-hmm.
And you incur some losses along the way, but the whole machine continues to run in the right direction. If like we break out into like all out war and it continues to perpetuate for the longer term, and then we start taking losses, AI stocks start to tumble, and it just like the whole thing stalls out. and you
Yeah.
start a downward trend. And everyone, if the market dips beyond like a certain point, like I'm not a market guy, but at some point you're like, this is so inflated that you're gonna bail.
Yeah. Last year in the first, I just had like a breakdown with my financial advisor, kind of looked at my portfolio versus last year, just kind of talked through what's happening. Like I'm not I don't turn on the news and then start making trades. I meet once a quarter and I put together an annual process. That way I'm not being driven by the news, because my goal is compounding interest over a long time, right? So bottom line is Q1 of last year, it was about a 20% drop due to tariffs. All the tariff volatility, all the conversations happening, all the concern. What's happening right now, the same period of time, all of the tumultuousness that's happening in the Middle East has been a 9% drop, and it's rallying right now. So like it is interesting to see that like we have these big moments and we don't really realize how big they are, but the same conversation's happening now, but it's not as big as it was.
I think, just to wrap up this, I think you being as young as we are, you're going to get compound interest. You're not selling. You will be just fine. You know what I mean? Don't do anything and just let it ride. But I guess what we're saying is like a lot of people that listen to this, a lot of our investors, they are older, 50, 60. And I just think that all of these risks make sense to de-risk a portfolio and go into cash flow recession resilient asset classes, because we're not sitting here saying that there is going to be a recession, but damn, there's a lot of things right now that could go one way and get us into a recessionary environment, get a big 20% sell off in the equity markets, and like the dominoes would fall, right? And then it'd be great. From a real estate perspective, from mobile home parks, we have long-term debt. It's fixed, and then Treasury yields come crashing down again. They start printing more money. Inflation keeps going. The prices of hard assets go and increase. We could refi and take advantage of short-term debt. So that's why even like if someone's like, well, Ben, you're going to be impacted too. Like, yes and no, but like we are so much more resilient than things that are paper, meaning things that trading on the stock exchange.
Our entire business model is based off of being resilient in a recession.
Yeah.
That's the whole point
in the recession. Yeah.
So,
because of the recession.
Yeah. I feel like we do good. And this, we don't pray for rainy days, but we do good when the times are good, and we do really good when times are not good.
Yeah.
All right. So I think that the consensus is you think we're going to throttle through it. You think we might have a couple stall out.
Hold on. All I was saying is that I don't think private credit is a canary in the coal mine to destroy the American economy. Like that is not something I agree with.
Right.
Fair
enough. We heard it. You heard it on the cash flow quest. Okay, so I want to transition to a market that seems to be netting a meaningful benefit with the oil dynamics, macro kind of oil trade dynamics. Mm-hmm. What's going on in the Strait of Hormuz, the Iran
market
war. So I was reading Zero Hedge just literally on the main page. I just check it like every other day. The main page
I don't know what Zero Hedge is. Is this some like conspiracy theory weird thing that we're putting out?
No, I'd say it's like the modern Wall Street Journal.
Okay,
it's kind of like the neutral position for like making sure it's not leaning. It's not Fox leaning one way. It's not CNN leaning the other. It's just news. And the headline is California exodus and Houston GDP expands exponentially. And so we've been kicking around markets. Texas has always been on our radar. And so, that has become something that we're zeroing in on. What big markets do we want to be in? Because we're like pretty low on the risk spectrum, I'd say, in general. And so we're going to be focusing on markets that have huge population growth, business dynamics that are moving in the growth patterns, meaning like that businesses are moving in. And then from there, we over 4 or 5 million people plus. And so that pretty much takes you down to like 10 or so markets in the whole country.
Like 8.
So
if they're conservative, when we say conservative, we mean landlord pro-business, markets.
Yep. So anyways, we're going to transition now from the cash flow quest, and we're going to jump into Houston as a market a little bit deeper. And so we're kicking off a investor circle where you guys can tune in to curated content for like a deeper dive and kind of how we kick around deals and how we underwrite and look at markets. And you could kind of dive in deeper with us. So move over to there and go to our website, comfortcapital.com, and you can click through the link to join the investor circle. So we'll see you on that side. And thanks for joining us for another cash flow quest. See you
Thanks,
later.
everyone.